A very good afternoon, everyone. Welcome to the Q4 2025 edition of the Blackfinch Aim in Focus webinar. For those of you who are new, my name's Josh. I'm the product specialist for our listed investment solutions here at Blackfinch, and I'm joined today by Lawrence Campin, a senior investment manager at Blackfinch Aim. So before we begin, it's important to note that the content of the webinar is intended for professional advisors, so the details aren't to be taken as financial advice itself, or when we mention single stocks, they aren't to be seen as recommendations. They're just examples of companies in the context of a well-diversified portfolio. But as always, any questions from the content, please feel free to contact eventswebinars@blackfinch.com and we'll be able to address them. So, we've an action-packed webinar today as we move towards the end of the year, and of course, on everyone's lips is the autumn budget. We have seen investor sentiment place downward pressure on share prices across some pockets of the UK market, including AIM. And I'm going to look to dig into the weeds on our view and the wider view and what's next for the UK. And after that, I'm going to hand over to Lawrence. He's going to cut through a lot of the fiscal noise and cover what's been going on under the hood for some of our companies and also emerging themes on a much broader scale for the UK. So after last year, the most important factor influencing UK markets is the autumn budget. It's scheduled to take place on the 26th of November, and it really does feel as though this can be an even more influential fiscal event this time around. It's well known now that the UK deficit is the widest it's been outside the global financial crisis and the pandemic. It's roughly sitting at about -5.5% to gross domestic product. And in our view, it's highly unlikely that tax cuts are going to be coming in the UK like the US has seen. And if you've been watching a lot of the chatter, that word of black hole just keeps appearing everywhere. And that is typically code for tax rises in politics. As a brief recap, Reeves announced a £40 billion increase in taxes. It marked the biggest budgetary tax hike since 1993. And of that 40 bill, an increase in national insurance contributions was expected to raise over about 60% of that. And it quickly rippled through markets. The outcome largely for UK investors was the UK business expected to shoulder that big tax burden. And as a direct result, business confidence plummeted. We've seen tax burden challenges near all-time highs. And although it's somewhat filled some of the black hole issue, it just isn't supportive for economic growth. And we are really seeing that come through in the figures. And it brings us onto the chart here on the screen. And initially, it shows why Reeves thought it necessary to raise taxes. So the chart displays the forecasts for UK public finances as a percentage of gross domestic product in terms of the revenue the government generates from their taxes and then what they spend. And in very simple economics 101, if the government needs more money, more revenue, then it should raise taxes. And that's what they did last year. That amounted to 40 bill. But what the chart shows is we just don't have a revenue problem. It's actually the spending. We have that spending issue. And from briefly reviewing the chart, and you can eyeball this, you can see that red revenue line. It's expected to flatline over the coming decades, up to 5 decades. But spending is just unsustainably rising over the same period. And there has been a lot of speculation on what changes we're going to see this autumn budget to help tackle the issue and allow that the UK government to balance the books. And I think the most attention-grabbing room has been potential limitations to how much tax-free cash people can access from the pension pot. So other policies under consideration, like changes to ISA limits, further tweaks to IHT and CGT rules. But let's just take a step back. And I think the key thing to take away is that for the moment, it's just all pure speculation. I've got no doubt you're doing this with your clients already, but just reinforce that making snap decisions based on rumors or on uncertainty can just derail long-laid financial plans, and that can prove to be headwind or costly over the longer run. Just as her announcement could spark some volatility, equally, she could announce support for smaller businesses to combat those NIC hikes and the impact of them from the previous budget. And then The more sensitive parts of the UK market, like AIM, could see some significant upside. In our view, the chart paints a very clear picture in the UK that raising taxes isn't going to narrow this gap between spending and revenue earned, and it could place some further pressure on the outlook. The UK economy as a whole, it's still combating sticky inflation problems. So I think the hopes of the Bank of England coming to the rescue and suddenly lowering interest rates more and more looks less and less likely. They've got to make sure they hit their 2% inflation target. We are also seeing some political gridlock in the House where the backbench isn't backing the front, and that makes it difficult to come up with tangible plans. And we saw it this year. The government tried to pass a bill to combat this big fiscal burden of sadly having one of the highest levels of persons on long-term sick or claiming benefits, but the backbench contested it. So we do have this issue where the other party thinks the wealthy can pay their way and take the pain, but we can see from the chart it just isn't achievable. And I read a really interesting statistic to last year end that in the late 70s, the top 10% of earners paid 35% of all income tax. It stands at 61% today. And these individuals are very mobile. They're able to leave the country with the rise of remote working and since COVID. And personally, I have friends that have done something similar because of that tax burden. So just to summarize, increasing those taxes could be broadly very difficult, although the word is very unattractive in political spheres. Austerity would be a more sensible option, and actually it can get the bond market back on Labour's side. Similar to 22 and Liz Truss, as we all remember, they play a huge and powerful role in shaping the direction of the economy. The yields on your benchmark of your 10-year gilt is still elevated. It's in a range from 4.5% to 5%. And maybe a more radical fix would in fact be major reform to spending plans like reviewing or privatizing the NHS. But we know that's political suicide. It's an unlikely outcome. So I think for the moment, it's likely going to be tweaks to minor income generators for the government. Never say never. There's still a lot of speculation at the moment. But for us in the AIM team, we really are looking for Rachel Reeves to provide some sort of vocalized support for UK businesses who have vocalized the need for help. They have asked for help with these NICs. So should we get that, there's big opportunity for some AIM companies to re-rate here, as sentiment has just been placing that downward pressure on pricing for some time. But with all of that in mind, I'll pass on to Lawrence, who's going to talk about some of the noise in the ground of our investee companies. So Lawrence, over to you.
Thank you, Josh, and good afternoon, everyone. So today I'll be covering two investee companies that have reported on trading recently, and they've been able to navigate challenging macroeconomic conditions. I'll then look to cover some themes we are seeing in the market before passing back to Josh for the wrap-up. So the first company I'd like to cover is Keystone Law, a leading UK law firm following a differentiated platform model and holding in the income portfolio. So the company released interim results in September, which showed strong revenue growth of 16.5% and further progress at the adjusted profit before tax level, with the margin increasing by 50 basis points to 13.6%. So Keystone was able to further leverage scale benefits and successfully put through price rises in April. And that more than offset rising employment costs. So as I say, Keystone follows a differentiated platform business model, which provides self-employed lawyers with infrastructure and central support and flexibility in choosing the location and volume of work they take on. So in return, Keystone typically retains 25% of client fees and ensure lawyers are paid when the client pays. So the company noted the recruitment market, a key aspect of the organic growth strategy, remains conducive to growing the principal lawyer base. And pleasingly, momentum has continued into the second half of the year, resulting in Keystone expecting trading to be ahead of expectations for the full year. So despite the good share price performance, which you can see on the chart, Keystone still offers, in our view, a respectable forward yield of 3.5% and has a history of paying out periodic special dividends. Moving on to the next company you can see here is Sigma Rock, the lime and limestone group targeting quarried materials in the UK and Northern Europe, and a holding in the growth portfolio. Now, Sigma Rock also reported interim results, and they actually said trading was in line with expectations, despite core volumes being down 3%, where there was some softness in construction and steel markets, as well as some customer maintenance shutdowns. Sigma Rock was able to improve EBITDA margin, again by 60 basis points, by working through planned synergy initiatives following significant acquisitions they've made over recent years. And they've actually confirmed synergies in 2025 are looking to exceed previous guidance. Now, free cash flow conversion was also ahead of the prior year, which, along with the disposal of some non-core assets, strengthened the balance sheet position. Now, as the chart shows, Sigma Rock shares have responded well to solid trading and operational improvements. And now, despite this run, we still view the value of the company as undemanding and expect further progress will be made over the medium term. So there remains a good opportunity for the company to improve volumes and margins as and when end markets recover, and the expected tailwind of the German infrastructure spending bill kicks in. Now, moving on to some themes we have noted across the AIM market. Now, first is a continuing theme, and it is the relentless takeover activity on AIM, which we still view as a strong indicator of the value on offer. A good example of this was Epwin, a long-standing holding in our income portfolio, and is the latest to receive an approach. So Epwin is a leading UK manufacturer of energy-efficient and low-maintenance building products, supplying well-known brands across new build, social housing, and repair and maintenance and improvement sectors. In August, Laumann Group, a leading global building products company, announced a recommended cash offer for Epwin at 120 pence per share. Now, this represented a 31.9% premium to the share price before the announcement. And while we believed Epwin was well placed to generate potentially higher returns for shareholders over the medium term, as market conditions improved, the takeover secured an immediate outcome for clients. We've also been able to use the proceeds and redeploy capital into new opportunities within AIM. Now, the first 9 months of 2025 has seen 4 larger AIM companies move to the main market. So while it can be disappointing to see companies move, we note this has always been a feature in the AIM market. And contrary to what some headlines suggest, the quantity moving up is not material. And despite the total number of companies reducing on AIM over the last few years, we still see plenty of quality companies that could be suitable for investment in the portfolios. It's also important to note that the AIM portfolios that Blackfinch run invest into a range of market caps with no strict size requirements, providing the company passes our liquidity tests. Now, what we're still waiting for on AIM is a meaningful return of the IPO market. So given the volatility in the macroeconomic conditions and the upcoming autumn budget, it's not surprising that Q3 only saw 3 IPOs on AIM. The forward view, however, is more encouraging, with EY Parthenon noting the IPO pipeline for the next 6 to 12 months is strengthening. And this is consistent with conversations we have been having with brokers. And so we do believe that there will, in the not too distant future, be a much needed improvement in the number of IPOs coming onto AIM. So with that, I'll pass back to Josh for the wrap up.
Brilliant. Thank you, Lawrence. Some great insights as always there. Now, that's everything for the October 25 AIM in Focus webinar. Thank you, Lawrence, for joining us today, and for everyone else tuning in. I do hope you've got some nuggets to take away for your clients' meetings in the coming weeks. But as always, any questions off the back of today's content, feel free to contact your dedicated business development manager. And as well, feel free to contact our emails on here. We're always happy to discuss anything through with you or any questions that you have. But the next webinar will be held on the third Thursday of every new quarter, meaning the next one is Thursday, the 15th of January at the same time of 1 p.m. So we look forward to seeing you there, and bye for now.